And sticking with energy, crude oil closing lower for a second day as investor appeal for commodities wanes. Stephen Schork is president of the Schork Group. He joins us now on the phone with his outlook. Stephen, always good to talk to you. And what's going on with crude today?
We have some strength in the dollar, Mark. So as goes the dollar, so goes crude oil in the opposite direction. It really seems that the crude oil market, well, not seems, we know from regressions that there is a strong link inverse relation to the dollar. The dollar has found some strength on Bernanke's statements from earlier in the week. Hence, we've gotten some uplift in the dollar, and we've gotten some corrective weakness down in crude oil. Unfortunately, Mark, all we've done now is trade down into the current range. This is a market that is still defined on the bottom in the mid-70s and then the top in the low 80s at this point.
Well, Stephen, according to analysts, I'm sure you heard the story today, Valero Energy saying it would close its Delaware refinery. What's that going to mean for diesel and gas prices in the Northeast going forward?
Well, I think we should get to the underlying, Mark. Why did Valero close down their Delaware plant? Why did Sunoco shut in their 400,000 barrel a day Eagle Point refinery? Because, Mark, these guys can't make any money. So what they're doing is they're doing what any business is trying to do. They're cutting back output because they want to see gasoline. They either want to see, Mark, gasoline diesel prices go higher. I should say they need to see gasoline diesel prices go higher, or they need to see crude oil prices fall.
Well, according to data compiled by us here at Bloomberg, that plant represents about 11% of East Coast refining capacity.
Oh, so now there's a concerted effort by the refining industry to improve margins, and you can either improve margins by lowering your import costs, i.e., lower crude oil prices, or increase your output cost. Output costs to date have not followed because demand is so poor. So the refineries are taking it upon themselves. They can't control the price of crude oil. The producers and speculators are driving the cost of crude oil higher. It's squeezing the margin on the refiner, so the refiner has to react, and the refiner has to take production offline in attempts to push oil, gasoline, and diesel prices higher.
And, Stephen, I was wondering if I could get your quick thoughts on a story that you told me you just got a chance to glance at the Bloomberg terminal. Barclays Capital saying that commodities will likely attract a record $60 billion this year as investors seek to diversify their assets. Is that about right?
That is about right, and that goes to the point that speculators and investors are driving the cost for refiners higher, and therefore refiners have to take turns to try and push gasoline and diesel prices higher. It's not a pretty situation for the consumer. For you and I, Mark, it's a pretty ugly situation.
Stephen Schork, president of the Schork Group, joining us on the phone from Villanova. Stephen, thank you so much. We appreciate it.
Thanks, Mark.